And it's a fairly sizable one, if not one that we had anticipated for a while.
Yeah, and I'm glad we have our next guest because it's all about the debt side of the balance sheet.
All right, let's talk to Jody Lurie. Jody Lurie is one of our credit analysts here, and she covers the travel and leisure sector for us here at Bloomberg Intelligence. And it's about Caesars agreeing to buy, I should say being taken over by Tillman Fertitta. Fertitta Entertainment is paying Caesars shareholders $31 a share in cash. But in order to pay that cash, they're going to have to take out some debt. So, Jody, this is something that, it feels like it's a long time coming because Tillman Fertitta has been working on this for a while.
Right. So Scarlett, I think, this has been rumored about since actually around the time of the Ides of March. I was super excited that the announcement would happen on the Ides of March, just for all the references with Caesars. Unfortunately, we had to wait another couple months. That said, I think, what's been so compelling about this story, and I think what sort of brings up a lot of uncomfortableness in the bond market is the history with the name. Now, mind you, the Caesars now is actually El Dorado that bought Caesars out of bankruptcy, and that's not the same Caesars that we're talking about. That was the leverage buyout that went through the restructuring. And even so, I think a lot of bondholders, for good reason, are a little bit uncomfortable by this story in general.
So I've got a net debt to EBITDA, and I went through the Chase Manhattan Bank credit training program way back in the day.
Nice.
So I know how to do this. But I've got EBITDA of only like 3.6. I got north of 6 times on a leverage basis. Jody, people like you guys don't like that.
No, we don't, Paul. And to make matters worse, the big question that we're grappling with is whether or not the change of control provision gets executed. Not to go into too much detail, but to make it as simple as possible. In the course of a transaction, there's some bond terms that allow bondholders to put the bonds back to the company. And so in those instances, you get 101% of par. And that's not potentially happening here. We're not sure at the moment. And what we're seeing, though, is that if you look at the bonds, they're not trading like they would be put back at 101% of par. So every indication we're seeing is that perhaps that's not going to get executed, which means that it's only, about a $6 billion price tag in terms of borrowing, as opposed to an $18 billion price tag in terms of borrowing. So that's a big nut to sort of grapple with, is whether they have to refinance all that almost $12 billion of debt, or if they just have to issue new debt and lever up the balance sheet further, and bondholders are along for the ride.
Okay, so any way you look at it, there's going to be a lot of moving parts here in order to get this deal done. Jody, you mentioned that there's some discomfort here for Caesars bondholders. Is this going to get in the way of there being enough demand? Is this going to affect pricing and the concessions that might need to be made?
I think, Scarlett, it really depends on timing. It depends on the communication. We've been really sort of surprised over and again by the appetite of bondholders and potential creditors out there. Now, will they have to pay up for it? It's very possible. And I think that creates the sort of interesting component too, is that if you're talking about a company that is already having issues from a profitability perspective, cash flow hasn't been where it wants to be. Management was focused up until Icon got involved last year. They were actually focused on deleveraging, but they weren't getting EBITDA up. So they were bringing down debt and they were refinancing debt and they were improving the capital structure, but EBITDA wasn't budging. So now we're in a scenario where we say, okay, we're going to, lever up the company further from a net profit, a cash flow standpoint. What does that necessarily mean if, they're going to be paying up on an interest basis? So it's really a complicated conversation. And I think it's one where nobody's going to be looking at this lighthearted if and when the deal goes through and if and when they do issue debt. I think there's going to be a lot of people culling over many documents to decide if it makes sense for them.
Jody, thank you so much. Appreciate that. And Jody Lurie, Senior Credit Analyst at Bloomberg Intelligence, following the gaming industry, amongst others. And again, the very highly leveraged Caesars, perhaps being taken out by Fertitta Entertainment. And then the question is, who's going to manage that balance sheet?